Hey traders, Jason here from Leavitt Brothers. Lots going on out there. Over the last month, the market has literally gone straight down and then straight up. From its October high, the S&P dropped about 200 points over a 2-week period, and then over the last 2 weeks, it's rallied all the way back. On the way down, the bears were hoping for just one more bounce to go short, but now that the market has moved up with force, it's the bulls who are hoping for one more little dip to buy. Kind of funny how things work like that. In this video, I'm going to do an update of my State of the Market series. I'll quickly go through the indexes and then run through some breadth charts so we can kind of get a sense of what's going on here. All right, let's get to it. All right, so here is the S&P 500. Kind of messy, lacks an overall trend. We have this is over the last 12 months. We have like a 300-point move down here, 300-point move down here, 200-point move here. So we got a nice trend here in the middle, but we've had some big interruptions. These are not comfortable, and if the index is going down that much, individual stocks that you're probably trading are going down even more. So it hasn't been one of those years where the market trends up, takes pauses, goes up, pauses. It's not one of those. These dips are not like very comfortable dips within uptrends. It's been tough. It's been nerve-wracking. If I come over to the current state over here, you can see that the index went straight down, straight up. We're now above the 200, which is right here, but we're still below the 50, which is right here. I would consider overall this to be kind of neutral. Okay, lots of selling on the way down, lots of buying on the way up. A lot of energy has been used in both directions. I can't say that one group has the advantage over the other right now. Short term, I guess the momentum is up, but so much energy has been used to go off the bottom that it'd be kind of hard to jump in here thinking the upside is just going to keep going and going. So I would consider it to be neutral. If I look, if I chart out, whoops, if you just kind of look at the if I kind of look at the high there and the low here, we're basically in the middle. We're in the middle of the 250. We're in the middle of the big range. Energy in both directions has been used. I don't know if I could feel comfortable just like buying and just taking a break for a month or two, or selling and taking a break for a month or two. I don't think it's that clear cut. Okay, so it's just the way it is. I don't think we have a dominant trend in place, at least not in the intermediate term. I think we got to be on our toes. Lots of flexibility. You got to be nimble. I just don't think there's a dominant theme in place that would make me comfortable just going all in and like, hey, let's see what happens. Okay, let's move on. Here's the Russell. It's worse off, much worse off than the S&P. Okay, although it's been easier to trade because you had you had a pattern over here, and then we broke out and ran up, and then we had a pattern over here and it broke out, didn't go very far, and eventually rolled over and collapsed. Gave everything back, was basically at a 52-week low. It's bounced nicely off its low, but we got the 50-day moving average is way up here, so it's you can see this coming up and maybe getting rejected and trying again. It'd be hard for me to think that this thing is just going to go roaring forward. Okay, I just don't see that happening. Okay, there's too much energy has been used up. The psychological damage that's taken place over the last month or so. It's going to take time for this chart to repair itself. Okay, in the near term, hey, it looks great. Trend is up a little bit, but if you look at the big picture, it's like, wow, you got all this supply sitting up here, people sitting there thinking like, I wish I had one. Can I have one more chance to sell? So I'm going to call this neutral and say maybe we move up, maybe we move down. I don't think I would be comfortable saying we're definitely going to do something. I don't know if any trader could actually be really confident that the market is definitely going to do something. Okay, it's just the way it is right now with volatility the way it is, and the lack of staying power of some of these moves and some of the gaps. Like, I'm just going to call it neutral and say anything can happen from here. One more chart, one more index chart. Here's the Nasdaq. Okay, it has stayed nicely within the Bollinger Bands, followed the 50 up right here, broke down, and then things got kind of messy here. But similar to the Russell, it's like you got the 50-day moving average here, and of course the 50 is trending down. So, until this thing can get up here and maybe come back down and test the 50 and go up, like, I don't know if you could be super confident. Okay, you could play it, go long, that's perfectly fine. But just know that any trade you take might only last a day or two, or maybe a week at the most. Okay, there's lots of overhead resistance. The overall trend has been disrupted. A lot of technical damage has taken place. So you should not feel comfortable being in any position. Okay, everything needs to be shorter term right now. All right, let's look at some indicators. Oh, not one more index chart. This is the S&P 500 up top, Russell 2000 down below. This is the weekly charts. The 50-week moving average has been very important. Okay, the S&P this week has done very well. It's gotten back above it. The Russell still isn't there. Okay, so it's something to watch out for. Okay, it's nice that the S&P was able to reclaim it, but if the S&P keeps going up and the Russell keeps going up, but the Russell gets rejected over here, it's going to be a problem. Something to keep an eye on. Okay, because these indexes don't have to move exactly together, but they got to be kind of close. So if the S&P tries to go up and the Russell gets rejected, it's going to be hard for the S&P to keep going up. Okay, something to keep an eye on. Now let's get to some of the indicators. All right, here's the S&P 500. In the middle here is the 10-day moving average of the AD line, and down below is the AD line. Okay, so the 10-day has done really well to get back up into what I consider like a bullish range. Okay, I talk about how when the market is strong, it will oscillate mostly above zero with occasional dips. You can see going back to April, May, June, you can see how the indicator just kind of rolled up and down in this box. That's what you want to see here. We've had a nice recovery. Okay, we had a positive divergence here, like here, positive divergence, fueled the move up. Now this indicator got back up. So what we need here is we need this to be able to stay above zero. Okay, it can bounce up and down. That's fine. Okay, as long as it oscillates mostly above zero, the market will be supported, and we should be fine. If that happens, then the AD line, the cumulative AD line, will get back above its 50, and all will be fine. Okay, right now I consider it to be neutral, maybe leaning down. Okay, it trended up, trended down, took out its 50. It's moved nicely off its lows, but it's not bullish yet. Okay, you still have going to have resistance up here. You still have levels over here that need to be contended with. Now you can't wait to get long until you can't wait for this indicator to turn bullish in order to get long, because I don't want to say it'd be too late, but you know, by the time it turns bullish, the market will have already been trending up for like, you know, maybe even 2 months. Okay, so but you have to just keep in mind that if you go long here, you know, the market is improving, but it's not in great shape. It's not one of those times when it's like, hey, there's a gentle breeze at your back and you can just kind of get in and just kind of go with the flow. It's like you have to be more active these days. You have to manage positions better. You got to have tighter stops. You can't just let things go. Okay, you have to be more active. Okay, so I would consider, you know, what's happening up here is a good first step, and now the step number 2 is we need the cumulative AD line over here to get back above its 50, and you know, see if it can consolidate up there and move up from there. The situation at the NAS is pretty much the same. Okay, we got a positive divergence here. 10-day of the AD line moved up. Now it's trading back in the box that I like to draw here. It needs to stay there. Off the lows, the AD line it's off the lows, but it's still got a lot of resistance over here. The 50 is declining, so there's a lot of work to do. Okay, so this move up has neutralized the move down, but there's still work to do. Okay, you can't just, hey, I'm going to go all in and just let it go for the rest of the year. I don't think we're at this situation. You know, I don't think we can do that yet. Okay, here's S&P 500, new highs at the NYSE, new lows at the NYSE down below. So what we have here is we have new highs are trending up. They're off the lows, which is good. New lows are trending back down. They're close to zero. That's good. It's a good first step. It's good. That's all I'm going to say. It's like it's improving, but we're not like in bullish territory yet. Okay, ideally we would get like new highs to be printing like somewhere up here. Okay, at least like up here. Okay, so it's like a step up. It's good. The world didn't come to an end. The market didn't completely collapse. That's all good, but it's only a first step, and we need continued improvement. If we don't get continued improvement, the market's just going to go back down into the recent low. Okay, so it's like step 1's in place, but now there needs to be more buying. Situation at the NAS is very similar. Okay, we have new lows curling up. It's good. New lows over here, back down to low again. It's a good first step. But, you know, we need new highs to print up here. Okay, each one of these rallies over here, if you look back May, June, even into August, back in February, March, each one of those those mini trends were accompanied by new highs printing at a higher level. So we need new highs to print up here. Okay, so we're off the lows. That's good, but it's not good enough to sustain a rally. Here's a different look at new highs and new lows. I'm going to start being a little bit more brief here. I don't want this video to be too long. Just want to point out in April, May, when we started put in that double bottom, actually kind of triple bottom, and we started trending up. Notice new highs started trending up, new lows started trending down. Okay, that's what we want to see right now. Okay, we got a little pop in new highs recently. We want to see new highs go like this, and we want to see new lows go like this. Okay, that's what we're looking for. Okay, nice bounce off the lows. That's great. It neutralizes the move down. But now we need to see, now it's been almost 2 weeks, so we need to see new highs expand. We need to see this happen for me to feel like, yeah, that next dip is definitely buyable. But if we don't get these types of prints for new highs, when we get a dip, the dip's going to probably keep going and going. It's not going to be buyable. NASDAQ situation is very, very much the same. Okay, at the beginning of the rally, that was, you know, here you started getting new highs just kind of ramped up slowly. There were dips in there, but they ramped up slowly. New lows were nowhere to be found. Okay, so we need that right now. We need to see this. Okay, if we don't see that, if this doesn't continue to happen, then the market's not going to bounce much, and then we're going to come back down hard, and because the market's volatile, we're going to come down really hard. It's not going to be just an innocent dip or moving sideways. It's going to come down hard. Okay, this is the high-low differential, so it's the highs minus the lows. I want to compare it to 2 previous dips we've had. Okay, so obviously right here, you can see in the red box, we have a big separation between the high-low differential and the 50-day moving average. Earlier this year, you can see we got a dip down, but you can see it flattened out, didn't separate itself much from the moving average, and eventually pulled back up, and the market did the same. The market, you know, righted itself and trended out. If we go back to the beginning, we go back to the middle of 2015, this current situation looks a lot like 2015, where it trended down, we got separation here, it got worse and worse and worse, and eventually, you can see what happened over here, the market collapsed. It fell a whole bunch. Okay, and even when the market bounced up here, the failure of the new highs to climb above the 50 is partially what led to, you know, leg down number 2. Okay, so if I zoom over to today, we need improvement here. Okay, we need this thing to curl up. We need to get back above the 50. We need maybe a test. We need to hold up there. Okay, if this thing stays below its 50, we're going to get a repeat of 2000 where we have, you know, where we just have another dip down. Like, maybe, who knows, maybe we maybe we rally into the end of the year, but we get something like, you know, what happened over here, and then we get another dip down early next year. I don't know, but all I know is that this thing better improve. Okay, if we continue to see this thing trend down and we get this separation here between the 50 and the indicator, the market's not going to go much higher. Okay, here's the situation that at the NAS. I'm not going to mark this up much other than just simply to point out that it's pretty much the same. It's flattening out, which is good. Okay, but we still have a big separation here that needs to be handled. Over here, you can see how it got worse and worse and worse, and you know what happened to the market. Well, we got 2 years. I mean, if you back this chart up, you ended up with like 2 years total of sideways movement in a range. All right, a couple more charts. Down below is the percentage of S&P stocks above their 20-day moving average. Okay, it's improved a great deal the last couple weeks. Okay, but it's got to stay. Okay, it's characteristic of an uptrend. When the market does this, we get consistent prints up here. Okay, so that's what we need. So if the market rests, moves sideways, does something like that, we need the percentage of stocks above their 20 to continue printing up here above 50%. And if that's the case, then I'm going to feel confident the market is going to trend up. Even if it trends up slowly, it'll probably trend up. If we get a move back below this box for more than just a brief amount of time, then we're probably going to do at least a double dip. Okay, that's kind of like what happened over here when we actually got up to a decent level, but then we just fell right back down, and we got up to a decent level and we fell back down. So if we get a repeat of that, then we're going to probably do at least a double dip down. Percentage of stocks above their 50. As you can see here, double bottom, nice move off the low, but there's work to be done, because characteristic of an uptrend is you get steady prints up here above 55%. That's what it's always been. Okay, back in February and March, 2 attempts to move up were rejected basically at the bottom of the boxes that I've drawn. So if we get the same thing here, you know, if this moves up and gets rejected here, the market's going to get rejected too. Okay, nice move off the low, good job, but there's still work to be done. All right, 2 more charts. These are the charts that probably bother me the most. I guess you can consider them one chart because one is of the NAS and one is of the NYSE. These are new highs on at the NYSE on the weekly chart. As you can see, it's been pretty weak lately, and it's a big problem. Okay, when the market does well, as it did like here, you get like all these prints up here. But on this last move up, you got, you know, higher, whoops. Sorry. So you got new highs over here, and you got a negative divergence here, plus just a complete inability to print any type of high level. Okay. Now I know there's some big companies out there, like one Apple is worth, you know, hundreds of smaller companies, but you still need broader based participation. Okay. If you look over here, while this was forming here, you had steady decline here, and then the bottom just fell out. Okay. And then when it bounced, you got very little improvement here. You got to move up, but it got rejected, and then you got another move down. So when I look at this, rally here, to me that's like this, and then it gets just rejected down, and like to me that's like what this is. So bottom line is, when the market moves up, we need prints up here. Okay, we need higher prints, we need better participation, we need more stocks hitting a new high. If we don't get it, the market's it's not going to go up much. It's not going to go up much longer. Okay, this indicator is not really sensitive, but if it gives us a negative sign, then it's one of those things we got to keep in the back of our mind that we have another big move looming out there. Okay, it's going to happen. The situation at the NAS is very similar. When the market was, you know, trending up, 2016, 2017, you had all these prints up here. Then here you have all-time highs, and what do you get here? You get a lower print, you get a negative divergence, and now we have a print that's like at a 2-year low. Okay, this, what's happening over here, looks like this. Okay, where the market was moving up and up and up, but the number of new highs was like down and down and down, and eventually, and what happened? We got an entire year of sideways movement. Okay, it depends on how you draw the box as far as how long it lasted. Okay, so we can get the same thing here. Who knows? Maybe we'll just get like this. Well, that's not the way I want to draw it. But maybe we'll just get something like this, and we'll just get sideways movement for the next couple of years. I don't know. But I do know it is a big problem that the lack of new highs on the weekly time frame just is not able to print a higher number, and that will become an issue. Okay, if you're like bearish, you're looking at this chart like smiling, because you're thinking, hey, if we rally into the end of the year, and this chart just simply kind of goes like this and then gets rejected by some level up here, that's like the best short of your life. Maybe not the best, but it's like it's the best, certainly the best short of the last 9 or 10 years. Okay, so that's it. That's all I have. If I were to sum all this up, I'd say the world didn't end. The market didn't completely collapse. We moved straight down. Now we move straight up. I'd consider the situation to be neutral, leaning up. The indicators have improved, but there's still work to done. There's a lot of overhead resistance to deal with. The indicators are doing better, but they're not yet in bullish territory. So I don't know if anyone could say, to be real, I don't know if anyone could say that they're like super confident the market's going to go up or down. I think anything can go here. If the market goes up, that's fine, but there's some proving that needs to be done. Okay, thanks for listening. Sorry I did this for like 20 minutes. I gotta get better at keeping them under 10 minutes. But again, thanks for listening. If you like the video and want me to do more, give it a like, share it with your trading friends. You can subscribe to my channel right here at YouTube. Come check us out at Leavitt Brothers. We provide trading ideas, market analysis to independent traders, funds, and financial advisors. Again, thanks for listening, and I'll see you next time.